Whatever led you to this video, be it investing in Palantir only because of Alex Karp's legendary hair, or, on the other hand, a more substantial interest in the long-term future of this company, I have something truly important to share with you today. PLTR's master plan for its future growth, scale, and profitability. After all, this channel is specifically about analyzing the potentials of a given business through an extended time horizon. So without further ado, or wasting a second uncovering the brutal macro environment, let's cut to the chase. The big picture. It's easy to get lost in the quarter-over-quarter numbers of any public company because of the media scrutiny and investor focus on each quarterly earnings report and conference call. So if you want to be able to invest in a company over the long run with ease, it is crucial to be able to transition between thinking monthly to yearly to 15 years out, which is why I'm going to be doing more evergreen videos going forward and not just covering any stock's daily movements. Growth and profits. I asked Palantir management about growth and profitability on the last earnings call, and they left a few hints that tie back to their master plan of client acquisition. I have the transcript to their responses, which I will highlight now, and I promise this is worthwhile. In response to my question about growth going forward, this is what they said. We are very much at the beginning here. We just did 47% growth in 2020, and we expect to do 45% growth in Q1 of 2021. But I think looking at that kind of misses the point around the TAM expansion that's currently happening. Look at the channel partnerships with Fujitsu and IBM among others, where we're not just disrupting the top 300 or the top 1,000, but really we have the ability now to distribute to the entire market, potentially tens of thousands of customers. And with our investments in the end-to-end, sensor-to-shooter workflows from space to mud, we're not just going after the roughly $60 billion of government IT spend anymore. We're talking about the $250 billion of US DoD weapons systems spend in 2020. Our product investments mean that we are uniquely positioned to seize those opportunities. It's about the power of Apollo. It's about software that manages itself. With a few clicks, you can deploy end-to-end powerful use cases that would have cost millions of dollars and taken many months, can now be developed in minutes. It's about software-defined data integration and modularity. That means that you get 100% of the power of Palantir, but with the ease of self-managing software. And these are examples of why we're confident in our long-term growth of being greater than $4 billion in 2025. And, in response to my question about profitability going forward, this is what they said. On profitability, I'd point you to our margins today. 84% adjusted gross margin in Q4, 81% for full year 2020, 62% contribution margin in Q4, 54% for the full year 2020, and 32% adjusted operating margin in Q4, and finally 17% for the full year. We have proven the unit economics this year, and we did it in a year where we did 47% growth, and this is why we are going to continue investing in that growth, and it's really a massive opportunity ahead of us. Contribution margins. I talked about the skill of being able to shift mindsets as a long-term investor. In the following clip, I'll be playing part of Palantir's original Investor Day webcast, linked in the description, which will explain the importance of contribution margins.
We have two platforms, two binary sets of written code, and our business is to distribute these platforms to our customers. So how do we measure how well we're distributing our platforms? We look at contribution margin, key metric for us. Contribution margin is a way to think about the cost that we bear to generate revenue. And as you can see here, we're getting much more efficient. Our contribution margins have increased nearly 4 times since the first quarter of 2019. And at the limit, we think these margins should converge with gross margins as we continue to invest in things like Apollo, platforms generally, which help bring our costs down.
Now, why is this so important? First of all, this holistic point of view of the collision between contribution and operating margins should already have some bells going off in your head, as it did with mine. A few reasons this is so crucial. 1. It hints at the potential financial strengthening of PLTR's business over time. And 2. Palantir has a plan to get there through their existing operations and essential cost reduction and client onboarding improvements. And this hypothetical future margin breakthrough is only the first part to the master plan, which I will be getting to very shortly. Before that, let's take a look at contribution margins with a few slides from Palantir's slide deck from its most recent quarter. Again, the PLTR contribution margin, in their own words, is defined as
way to think about the cost that we bear to generate revenue.
So here we have the adjusted gross margin and contribution margin overlaid in a year-over-year comparison. Of course, it's great to see the upward trend, especially given these impressive figures. But can the trend continue and lead to profitability? That is the question. Can the actual margins get anywhere close to where the contribution margins are? For that, we'll need to rewind again for more holistic statements from the PLTR Investor Day webcast. The master plan. I'll play a clip and then be back to break it down.
Next, we're going to talk a little bit about the business model. Specifically, I'm going to talk about the life cycle of an account. We break this down into 3 phases: acquire, expand, and scale. In summary, what we're showing you is how we go from a loss leading category, acquire, grow through the expand phase, and go into a positive contribution margin phase that we call scale. So I'm going to break this down by category, starting with acquire. So a big investment here, $65 million in a category with essentially 0 revenue. These are new installations, the land phase of our relationship, accounts that we intend to grow. And if you look forward 6 months, we're doing some of that. We're generating just under 19 million of revenue, but still in the negative contribution margin category. So as we grow these accounts, we'll be looking to move them into the expand and scale phases. Next is the expand phase, which accounted for about 24% of our revenue in 2019. The objective here is that we should be growing revenue and finding the inflection point to positive contribution margin. And if you look 6 months forward, we're doing just that. These accounts have continued to grow, generating almost the same amount of revenue in 6 months as they did all last year. So strong growth and retention. And we've done this while hitting the inflection point to positive contribution margin, going from negative 43% to positive 35% in 6 months. If this continues on average, it looks like these accounts will advance to the scale phase. The scale phase is the majority of our revenue, about 76% of our revenue last year, and generating the bulk of the contribution margin. This is where we should be constantly getting better. And you're seeing this from 2019 to today. 55% contribution margin in 2019, 68% contribution margin in the first half of this year. How high can this go? And to give you a little more color, I'm going to break this down into the top quartile of our scale group. The top quartile generated 87% contribution margin last year and 89% so far this year. So you could see what we're striving for, what is possible with accounts when we leverage the platforms and continue to invest our R&D dollars. What I've walked through is the life cycle of a customer account. It's not meant to be a timeline. Our objective is to make the acquire and expand phases as short as possible so we can grow the scale phase accounts. When we look at this as a whole, all customers should be scale phase over time.
So this is what I'll be calling Palantir's master plan going forward, its acquisition scheme. We have the acquire, expand, and scale phases. And if none of this is making sense to you, come back to this point after watching some of my previous and more introductory Palantir videos. But assuming you understand, as I believe I do, with at least a shallow understanding of each of the following: Palantir's mission, vision, principles, total addressable market, products, value proposition, customers, distribution techniques, and expenses. Given a rough and general understanding of all of those, this is how Palantir synthesizes everything into 3 steps for scaling its business. The acquire phase. In the acquire phase, Palantir makes its offer extremely compelling for new customers, with implementation and onboarding at little if no cost. Therefore, Palantir operates here at a loss. Palantir considers an account in the acquire stage if it doesn't produce more than $100,000 in any respective year. The expand phase. This second phase is often significant to understanding the principal challenges faced by customers in order to ensure that Palantir's software delivers value and results. An organization's account enters the expand phase when it generates more than $100,000 in revenue in the respective year. And in this phase, once a first pilot has been validated, Palantir invests further to integrate the platform as much as possible for the customer's organization to help tackle any key challenges facing such a client. Palantir also, again, operates in this phase at a loss. The scale phase. In the scale phase, once the software has been installed, configured, and implemented across all necessary divisions of an organization, clients become self-sufficient after passing through the first two stages. And, at this point, customers can start taking full advantage of developing software and applications with modularity running on top of Palantir's platforms, as explained during demo day. At this stage, the cost of revenue generation decreases substantially. The onboarding costs have been paid. It's relatively smooth sailing from here on out. This is the stage where the customer starts to have a positive contribution margin. Therefore, from here, what makes everything Palantir does worth it. Going forward, the customer relationship becomes profitable. There is a caveat, however, which is that the contract could get redefined with new use cases developed, making it return to the expand phase. Historical context. For context, as I often like to provide in these high-level discussions, in 2019, Palantir generated $566 million in revenues from customers in the scale phase, with a contribution margin of 55%. This means that 55% of the revenues are in excess to those used to cover for fixed and variable costs to the scaled customers. More recently, in 2020, Palantir generated $613 million in revenues from customers in the scale phase, with a contribution margin of 70%, which is again the percentage of revenues in excess to those used to cover fixed variable costs for scaled customers. Overall, great to see. Thus, this gives Palantir more flexibility in making investments back to push more customers into the acquire phase and to invest more back into the expand phase. The vicious cycle that should, as years go by, and yes, this won't be quick, but should turn the company overall profitable. Maybe I'm missing something, but I think this business model that Palantir has given us answers at least my questions about growth and the march towards considerable profits. Conclusion. Palantir's business model operates primarily through three phases: acquire, expand, and scale. In the first two phases, customers go through a pilot, acquire, and if the pilot proves successful, they move to a second phase, expand. In both phases, as Palantir proves the project's technical feasibility and it makes any necessary customizations to expand it across the whole organization, it runs those projects at a loss with a negative contribution margin. However, as the customer and account move into the scale phase, its contribution margin becomes positive and improve over time. And we heard them say earlier in the clip I selected that all accounts should eventually hit the scale phase, meaning if there is anything worthwhile in a given contract, it should eventually turn into a very profitable endeavor. There should be no in between. It's more of a transition period, and I think that is huge for Palantir. And going up the staircase as they increase those clients in their scale phase should offer almost a staircase effect, as Palantir is able to recognize more and more revenue over time. So drop a like if this video was insightful. I certainly think this underlying focus of Palantir and its three phases is necessary to keep an eye on. Please let me know your thoughts and leave any comments for what you want me to cover in future videos. Until next time.